Welcome to Talk Tickers. Today we're doing a full autopsy on Oxford Industries' Q3 earnings report, ticker OXM. Management dropped their results after the bell, and, well, what happened next was a total bloodbath.
Yeah, the stock just completely imploded. We're talking a drop of over 21% in a single day on huge volume. Now, a move like that, it just forces you to ask one really simple question.
So, what on earth caused the collapse? I mean, why did the market react with such brutality? Well, this is where the story gets really interesting. All right, let's dive in and figure this out. Okay, so check this out, because this is the crazy part. On the surface, the quarter looked fine. Actually, you could even say it looked pretty good. They beat what analysts were expecting for revenue, and they beat on adjusted earnings per share. So this is the big puzzle we need to solve, right? A beat on both the top and bottom line, followed by a total catastrophic sell-off. The answer, you can bet, is not in these headline numbers. We've got to peel back the layers.
Okay, so let's start the autopsy. Time to dig past those headline numbers and find the cracks that were forming just underneath the surface.
And boom, right away we find our first big clue. Just look at the massive gap between that adjusted loss of 92 cents a share and the official, the GAAP loss, a whopping $4.28. So where's the difference coming from? It's almost entirely a $61 million non-cash impairment charge they took on their Johnny Was brand. Now, in plain English, that's management basically admitting the brand is worth a whole lot less than what they paid for it. That is a huge red flag about the long-term health of that business.
And the rest of the numbers here, they paint a really mixed picture. I mean, on the one hand, full-price direct-to-consumer sales, that's their most profitable channel, it was up a decent 3%. Okay, that's good. But look at this. Gross margins got squeezed by a painful 280 basis points. And the wholesale business? That's a key sign of how confident their retail partners are. Well, it completely fell off a cliff, down 11%. Yikes.
All right, so let's see how this all starts to fit together. We're going to compare the, let's say, optimistic story management tried to spin on the earnings call with what the numbers were really screaming.
So here's the official line from the CEO, Tom Chubb. He's framing the quarter as basically meeting their own internal goals, and he's focusing on how the team executed in a tough market. It's a very standard stay-the-course kind of message.
But that calm, cool, and collected statement, it's masking some really serious problems under the hood. For one, gross margins got hammered by about $8 million just from tariffs. Management talked about a highly promotional environment and said the consumer is being increasingly choiceful. That's code for people aren't buying. And then there's that wholesale channel again, just flashing bright red warning lights. This is the stuff the market was looking at.
So what was management's excuse for all this? Well, they tried to shift the focus, really. They built this whole narrative around two things. First, external problems they couldn't control, and second, their internal long-term strategic plan to fix things.
And this slide just perfectly illustrates the huge disconnect. You had management pointing to the rearview mirror, right? Talking about as-expected results and all this foundation work for the future. But the market? The market was looking straight ahead, through the windshield, and it saw an absolute disaster coming. We're talking slashed guidance, a really weak start to the holiday season, and just severe pressure on their margins.
Now, to be fair, management did lay out a pretty clear three-part plan for that foundation work. First, they're bringing in new leadership to turn around the struggling Johnny Was brand. Second, they're investing more in that unique Tommy Bahama restaurant experience. And third, they're close to finishing a big new fulfillment center in Georgia. These are all long-term bets, for sure.
But then, in the Q&A session with analysts, we got the real story behind all the near-term pain. This quote reveals a massive self-inflicted wound. See, they were so scared of big tariffs on Chinese goods that they proactively cut way back on key holiday items, especially sweaters. So yeah, they might have dodged a tariff bullet, but in doing so, they created these huge holes in their inventory right as the holiday season kicked off. They just didn't have the stuff that customers actually wanted to buy.
And that right there brings us to the absolute heart of the issue. The market didn't panic because Q3 was a little messy. No way! The market panicked because of what management said is coming next. It was all about the forward-looking guidance.
And here it is, this slide. This is the guidance cliff that sent investors running for the exits. Just look at this. Last year, they earned $6.68 in adjusted EPS. Now, they're guiding to just $2.20 to $2.40 for the entire year. For the all-important fourth quarter, they think they'll earn somewhere between 0 and 20 cents. Compare that to $1.37 last year. And comp sales are now expected to be down mid-single digits. This isn't just a small adjustment, this is a complete decapitation of their earnings power.
So management laid out the reasons for this massive cut, and it's basically a perfect storm. The holiday season started out way softer than they planned. Their product mix is all messed up because of those tariff decisions we talked about. The competition is getting super promotional, which means more discounts. And on top of all that, both foot traffic and conversion rates are trending in the wrong direction.
And if all that wasn't enough, they put a number on the full-year hit from tariffs. We're talking about a $25 to $30 million headwind to their profit. That is a significant direct hit right to the bottom line. So, okay, after sifting through the wreckage of this report, where do we land? It's time to make the call. It's time for our verdict in the next call.
Our rating on Oxford Industries is a clear underperform. The fundamentals here have deteriorated way faster than anyone expected, and honestly, the path forward is just filled with uncertainty.
And here's why. First off, a guidance cut this big, it just signals a fundamental loss of visibility, a loss of operational control. Second, that margin erosion is severe, and it's coming at them from all sides. Third, the Johnny Was turnaround, that has immense execution risk. I mean, it's a huge question mark. And finally, they're facing a consumer who's pulling back, and they're doing it at the exact same moment their own product selection is broken.
So what's the trade idea here? Well, our thesis is that while that 21% drop might be a bit of an overreaction, the near-term outlook is, well, it's toxic. The smart play here is probably to just avoid the stock completely. Wait for concrete proof that the bleeding has stopped. Now, you could consider a speculative, high-risk entry, maybe somewhere below $30 a share, but, and this is a big but, only after we see the Q4 results and get some proof that the Johnny Was plan is actually working. And one last word of caution, the short interest on this stock is over 17%. That means it's a really crowded trade. It's like a coiled spring, ready to squeeze shorts higher on any good news or completely fall apart on any more bad news. The volatility is going to be extreme.
And as always, this is not financial advice.